Welcome back to this edition of The Tax Lawyer. I'm Scott Drake, and my guest is the tax lawyer who was writing in Forbes in this piece, Robert W. Wood, with Wood LLP in San Francisco. With trusts, crummy is good, is the article in Forbes. Rob, welcome back.
Thanks, Scott.
I guess we can have a discussion overall on a couple of things here. I like this idea of this specific kind of trust, and maybe we can cover, what estate planning and estate tax is going to look like in the near future. But what is a crummy trust, and what is it used for?
Well, crummy is I guess with slightly different spelling, is not a name for a bad trust. Crummy was a tax case, and so people since then, estate planners, refer to a crummy power or a crummy trust. And it's a provision in the trust document, basically, that allows a beneficiary to take money out, and that gives basically usually calls for a procedure where the beneficiary is notified that they could take money out, and then the hope is typically of the grantor or the settlor of the trust that they don't take the money out. So the sort of fiction here is for gift and estate tax purposes, you need to be able to have a beneficiary, typically a kid or grandkid, a child, take money out, but you don't really want them to. You want it to stay in, and that is advantageous in terms of estate planning. So that's the goal.
Okay. And it involves, like, again, you said that the money is used to pay the annual premiums on a life insurance policy, and then when the time comes, the benefit is paid back to the trust.
Yeah, so I mean, yes, thanks for the detail. Right, so the most common circumstance this is used would be with life insurance. So if I want life insurance on my life going to my daughter, let's say, I, rather than, for a lot of tax advantages, I put the policy into a trust, and I put money in every year to pay the premiums on the life insurance policy that's in the trust. One big goal of that would be that when I die, the policy proceeds get paid into the trust and not into my estate, so that they are basically tax-free of income tax, free of estate tax, which is a really good deal. So to pay the premium in every year, what if I wanted to do this in sort of the most tax efficient way, I put the premium money in the trust. My daughter then has a 30-day right, and this would be called a crummy power, a right to take that money out if she wants. And I'm hoping that she won't, so that in fact it pays the premium. Ultimately, the policy proceeds are going to go to her anyway. So unless she desperately needs the money, the smart play for her is to leave the money in the trust, let it pay the premium, and then of course she ends up getting the bulk, the money upon my death.
And so when it's all done the right way, then there's no gift tax, and then everybody wins. That sounds like a great idea.
Yeah, I mean, that's the thing. Everybody wins. And so, as you can imagine, most people, I mean, I almost suggested it in the way I described it, most people don't really want to send these letters out, a crummy letter saying, "Dear daughter, there's money, there's $13,000 just to use the annual gift tax exclusion amount. You can take out if you want. If you don't, it will be used in this way, but this is your notice that you have the right to do that for 30 days. Most people don't really want to send those out because they don't want the money to be taken out. But, I mean, if you want to have a pristine sort of plan and be able to prove to the IRS that you did it, you need to not only do it, but maintain proof that you did it. And part of that is making sure that either you or preferably your professionals are tasked with doing it every year to make sure that it happens and that it's documented.
Okay. Speculate in the last minute or so here on estate planning in general, and it seems like the waters are sort of murky at the moment, but how can one plan for future possible estate tax changes coming up?
Yeah, boy, I mean, I think it's my own view, although I have to warn that I'm typically not very good about projecting these things. I have no crystal ball. But my own view is something similar to what we have will likely be continued. Whether that will be made permanent, the $5 million exemption that we now have from estate tax and the unified estate and gift combined at $5 million, and the portability, so-called portability, I think that will stay in. I think all of it is likely to stay in. I think one big wild card, though, is will it be another sort of a 2-year Band-Aid, or will it be made permanent? That's one big question. And of course, I could be entirely wrong. It could be that we will, in a big fight over this, we'll go back to $1 million exemption, which is what's supposed to happen in the event that Congress can't reach agreement.
Mm-hmm.
I think, one more thing, Scott. I think there is talk, of course, among some circles. Senator John Kyle would be probably the major proponent of this, and that is complete repeal of the estate tax. I don't see that in the current political climate. I don't see that as remotely likely. So I think it's pretty safe to say we're stuck with an estate tax of some sort, for probably another generation.
All right, Rob. Good information. Again, thank you so much.
Thank you.
Again, my guest is the tax lawyer, Robert W. Wood with Wood LLP in San Francisco, who writes in Forbes. We're discussing his article with Trusts, Crummy, that's C-R-U-M-M-E-Y, is good. I'm Scott Drake. Thanks for watching.